We all want to know a little more about retirement accounts, so let's hand it over to the subject matter experts and get smart on all things 401k.
Welcome to SWAPA 401k and Investments Committee Retirement Education on our CBA Section 5. I'm Drew Payne. I'm the chairman of the SWAPA 401k Committee. With me today is Damian, Jennette, and Brian August. Today, we're looking at qualified and non-qualified plans, 2025 IRS limits, and where to find updates to those limits annually, how the qualified plans work, how the non-qualified plans work, crowding out, and pay statements. Qualified plans. There are two main types of qualified plans we have, which is the SWAPA 401k and the Southwest Airlines profit sharing plan, and the defined benefit plan, which is our market-based cash balance plan.
If you look at the defined contribution plan, there's two divides. There's what the pilots can contribute towards their plan. There's what the company can contribute. So that's the pilot deferral and the non-elective contribution that you see under these two bullet points. So the non-elective contribution for 2025 is 17%. 17% of all of your eligible earnings will be contributed to the 401k plan up until the IRS limits, which we'll discuss shortly. The pilot deferral amount is completely separate and independent. You can defer 5%, you can defer 15%, 25%, whatever your strategy is for putting money into your retirement plan. That's your side of it. And there's IRS limits on that as well. $23,500 for 2015, unless you're over 50, it's $7,500. And then we'll talk about the super catch-up as well. That only affects folks that are 60 to 63. So when we talk about the 401k, that's the two sources of money, the non-elective contribution and the pilot deferral, up to a point. And the next point there is the swap profit sharing. So if we get profit sharing this year, whatever monies that will be, we'll either go into a profit sharing plan, which is separate from the 401k plan. It's housed at Empower. For those that qualify, for those that haven't reached the IRS limit. Once you've reached the IRS limit, that profit sharing money will come back to you most likely as cash, depending on elections that we make every fall. And we'll go into that in a few minutes as well.
The 2025 IRS limits apply to the qualified plans. So the 401A17, the compensation limit, that applies to both the defined benefit, which is market-based cash balance plan, and the defined contribution, which is the SWAPA 401k and SWA profit sharing plan. That $350,000 compensation limit applies to all of the plans. Now, the 415C, 402G, and 414V, all of those go towards the defined contribution or DC plans. Once again, the SWAPA 401k and the Southwest profit sharing plans, they only apply to that. The 415C, which is the total contributions limit, that's the $70,000. That includes the 402G, the employee contribution, the $23,500, any of the NEC money, plus the profit sharing. And we'll go in more detail in a couple of minutes in the next few slides. The 414V, that's the catch-up and the super catch-up, that is on top of the $23,500. That's additional monies that you can defer away. On the SWAPA 401k website, you can see this pipes diagram. You'll see the little numbered bubble 1, 2, 3, all the way down to 12, actually 13. On the website, you can look at a description that's in more detail. So take a look at that. We've just outlined the entire retirement vehicle for the NEC, the SWAPA 401k, and the Southwest profit sharing plan, where the money flows, and we'll go into more detail now. Going over the SWAPA 401k plan, so remember that's the company NEC, non-elective contribution, and also the pilot contributions. So once again, we said before, the $23,500 is part of the qualified plan that is part of that 415C limit. The NEC goes into there, that 23,500. Once you exceed the 70,000, then it would either go into the excess benefit plan or come back as cash. And we'll talk about that in a couple of minutes. Additionally, if you have exceeded $350,000 of compensation, then that money would go into the non-qual 401A17 plan or come back as cash, whatever you have elected.
So I think in this graph, it's actually good to point out the horizontal red line in the middle. So it's a box in, and what's boxed in is the NEC and the pilot contributions. So if you take from that striped horizontal line and look left, this is the 401k plan. So there's a lot of confusion. A lot of people, don't quite understand where profit sharing fits in or the non-quals fit in. You can see the profit sharing is outside of this red box. The non-qual plans in yellow below are outside of this box. The 401k plan consists of two components: pilot contribution, company contribution. That's it. Depending on how much the pilot contributes will determine how much the company contributes via their NEC. We'll go into those limits in more detail. But as Damian mentioned, you can only put $70,000 total between the company and between the pilot into this part of the qualified plan. The exception to that are the catch-up contributions. If you are between 50 and 60 and then 60 to 63, there's an additional 3750 that you can put in. But aside from those catch-up contributions, this 70,000 for 2025, this is your 401k plan with the NEC and your contributions. Everything that's in this box is record kept and housed at Schwab. So this is your Schwab plan within this red dotted box. Everything outside of this, the non-qualified plans and the profit sharing plan, these are housed / record kept at Empower. So profit sharing, there's 3 non-qual plans. One of them is not on here, but we're going to talk about the top plan very briefly later. And the market-based cash balance plan. Those all fall outside of the swap of 401k. Therefore, they're all at Empower, freedomtoretire.com.
So visually, let's take a look at the defined contribution plan, just the SWAPA 401k first, because we talked about before that the SWAPA 401k and the profit sharing plan, those are tested together. So let's just look at the NEC and the pilot contribution here. So as your wages increase, and in our illustration, we show you someone that reaches $350,000 in wages, they'll get that 17% NEC. It's automatic, goes into the 401k plan. And then the contribution, the 402G limit is $23,500. That 402G and that 401 and the NEC, when you combine those together, and if you've exceeded $70,000, that 415C limit that we talked about in the limit page before, once you exceed that $70,000, it then comes back as cash or goes into the excess benefit plan if you've elected that.
Damian, talk about that excess benefit plan and the election on that. When would he or she elect the excess benefit plan? And then how long does it take for it to apply to your retirement plan?
Good question. So generally the company has an open enrollment season. I believe it's in October, November timeframe, late fall. And then it will apply to January 1st of the next year. And it is an evergreen election. So if you make that one election, it will keep doing the same thing year over year unless you make a change to it.
Yeah, so there's a couple things to think about when you start looking at these excess benefit plans, both the 415C excess and the 401A17 excess benefit plans. So they both capture certain amounts of spill. So that 415C excess, once you hit that 70,000, that the next $13,000, if you wanted to capture that into a non-qualified plan, you could do that. Once you hit that $350,000 limit, the 401A17 will kick in. And if you're in that 401A17 plan, your 17% of anything above 350 will go to that. So as Damian said, you can elect that during open enrollment. You can then deselect that the following year, 5 years later, whatever you want to do. But once those monies go into a non-qualified plan, either of those two plans, and we're not talking about it right now, but the top hat plan. But once you put money into those non-qualified plans, that money is not yours until you separate from Southwest. So there was we had a few phone calls during the COVID period. You know, the markets were going very poorly. People were concerned about the survivability of the airline, and they wanted their money out of that non-called plan. They wanted to know they had it. You cannot get that money once it goes into that non-qualified plan until you leave Southwest. It's subject to creditors during bankruptcy, so that money effectively is no longer yours. It becomes Southwest to potentially pay off creditors. So that's a risk. And I bring up COVID for the simple risk that we're always looking at Southwest balance sheet saying, hey, Southwest has this fortress balance sheet, fantastic balance sheet. Look at how good our financials are, minus the earnings as of late. But we have a strong balance sheet. That is true. But COVID was an existential event that could potentially have bankrupted all airlines. And obviously we had a government bailout, which prevented that from happening. But had that occurred, that was an event that no one saw coming that could have potentially taken people's money that were in those non-called plans. Now, it's not to say there's not a time and a place, you know, perhaps as you're a little bit closer to retirement. So we generally tell people that are in their 30s and 40s that are exceeding these limits, those non-called plans may not be for you, just simply because of the length of risk exposure you have. The other really important note about the non-qualified plan is how you elect to have your money. You either get it the year after you retire as one lump sum, which may be a fairly significant tax event that particular year after you retire. So something you need to think about. You're no longer working theoretically. So you're going to pay a big chunk of that money in taxes. It's going to raise your income level, depending on how much you have in those non-qualified plans. Or you can elect to have it paid out essentially as an annuity. It gets paid out over 5 years, starting the year after you retire, over 5 years. That helps on the tax distribution side of it. One of the things that it doesn't do, though, is it doesn't prevent that money. If your first year after retirement, Southwest goes bankrupt and you haven't taken that as a lump sum, guess what? That money is at risk that many more years. So just a couple things to think about on the non-qualified plan. So we do get a lot of questions over that year round, and especially during the open enrollment season.
I should say that the two non-qualified plans are shown, excess benefit plan and the 401A-17 plan. Generally speaking, we have three non-qualified plans. Two shown here are a result of excess funding over qualified limits. The third non-qualified plan, the deferred compensation plan, often referred to as Top Hat, is an elective plan, and it is not the result of excess funding over qualified limits. And we'll touch on that later.
The last 2 points I want to make on this is on the 17% NEC. On the slide you see it says max of 59,500. That's nothing more than taking 350,000 times 17%. So that would be the maximum that could go into it. But if you put in up to that 402G limit of 23,500, then you're going to crowd out, and we'll cover that at the end of this presentation. But if you put that money in first, then that will cause the excess. So 23,500, you put that in, the company's going to put the money into your SWAPA 401k all the way up until it reaches 70,000 in total. So your pay statement would actually show 46,500 on the pay statement. So that's where that excess comes into play that we talked about before. And the last thing I just want to quickly mention on that pipes diagram that you saw before, the catch-ups, you'll notice they were kind of like an auxiliary fuel tank that were attached to the main qualified tank. So that is, as Drew and Brian have both mentioned, that is up and above the 415C. It's additive to all of it. But just wanted to point that out one more time.
And I'll point out one thing, Damian, just since you mentioned the 46,500, the simple math so that everybody can see it. That max contribution on the NEC of that 350,000 limit times the 17% gives you that 59,500. If the pilot contributes their max 23,500, forget about the catch-ups. That doesn't count in this math. That 46,500, subtract that from that 59,500. That's how you get that 13,000 on that excess benefit, that 415C excess benefit. That's why that says max of 13,000. That's just the difference between the 46,500 and the 59,500. That's the max possible up to the IRS 401A17 limit of 350 for 2025.
Walk us through slide 9, because here we've got highlighted the profit sharing in a red box to the right.
Yep. So the Southwest profit sharing, this is just designating that it is part of the total retirement program that we have on the 401k side. So you have your NEC and your pilot contributions make up the bulk of it. But if there's any room left, and if there are any profit sharing dollars, then that would continue to fill the qualified plan all the way up until it reaches that 70,000 max. If you've already reached that maximum and there is profit sharing, then it would either be paid to you in cash, or if you've elected the excess benefit plan, then it would go back to you. Also, if you have exceeded the $350,000 compensation cap, then that would either come back to you as cash, or if you've elected the 401A17 plan, it would then go into that. But we'll cover that in the next slide. So just to look at this is just now showing the profit sharing plan and how the whole defined contribution plan works together. So just to reiterate the point, remember that the NEC plus the 402G pilot contribution plus the profit sharing plan, that is, once you hit that 415C limit, that's when you have the excesses for the excess benefit plan or cash over that $70,000. So those three things added together is if you've breached that limit.
And I guess the one point of clarity is, again, you still have that limit for the pilot contribution, which is 23.5. So once you subtract that 23.5 out of that 70, you've got 46,500 left that your profit sharing plus your NEC times whatever you've made makes up that balance. So the higher earners out there aren't going to see profit sharing as part of their 401k contribution. That profit sharing is going to go, most likely for the higher earners, it's going to go into cash. And I guess the one other point is, so of that 46,500, you'll hit that once you make $273,529. So anybody making more than $273,530, let's say, once you've reached that $273,530, you are not going to be eligible, assuming you've put your $23,500 in. You're no longer going to be in this qualified part of it before you get into the various spill, whether it spills to cash or whether it spills into your non-qual plans.
So now turning to the defined benefit plan. So of course this was introduced in the new contract, but the market-based cash balance plan, today it's fairly simple. It's just 1% of your wages goes directly into the market-based cash balance plan. But there is a limit. So the 401A17 limit of $350,000. If you multiply that by the 1% that we get, the direct contribution, that means the maximum that can go in there today is $3,500. Of course, 2026, we'll see that go to 2% for everybody. So to note, if you reach the $350,000 limit, above that, if you've elected the 401A17 non-qual plan, it will go into the non-qual plan. Otherwise, it will come back as cash.
So Damian, you talked about 2% in 2026. Can you elaborate a little bit on that?
Well, that was just part of the ratification in the new contract. That's just on schedule in Section 5. That will be bumped up to 2%. I'll just make a quick note that the spill cash provision, which that was kind of the big hype during the negotiations, that letter is still with the IRS, the private letter ruling. We haven't received any update yet, so that's why we're not going in grave detail about that system, because we'll put out a lot more information once that gets approved by the IRS. But as of right now, it's not worth going into depth.
Our one and only DB plan is administered by Southwest Airlines and record kept by Empower at the website freedomtoretire.com. And the link to that plan also exists on swapa.org under committee's 401k committee. We have links to the plan, so you can link to your DB plan through a different record keeper than you're used to with Schwab.
One more note about the market-based cash balance plan. We do not have an option to invest that in funds that SWAPA chooses. That is a 40-60 stock versus bond or portfolio that the company basically has the full right, but it will maintain a 40-60. And again, it's fairly conservative, but the company has to make up any losses incurred by that fund to bring it up to par. And Damian, you could probably explain that better, but the idea just making sure that they understand it's a 40-60 and it's not anything we have control over.
Yeah, you don't have control over the investments. We could monitor it.
Yeah, I mean, you're exactly right. There's a preservation of capital requirement. So DB plans, think of it this way. Defined contribution, the 401k and profit sharing plans are always receiving money now, and DB plans are always forward looking. So DCs are currently and DBs are forward looking because they're looking at about 10 years. And so, there's PBGC premiums that the company has to pay on that, and a preservation of capital that we just talked about. But the good thing is that 59.5, whatever has accumulated in there, you can transfer into the SWAPA 401k plan, which we highly suggest.
And the balance isn't updated as often. It's quarterly now? It's not like your 401k where you get a balance every day at an NAV.
Yeah, it is. It is a quarterly statement that comes out, and to your point, there's nothing we can really do about it. So I know people do get angry that they don't have instantaneous information on it, but that's just how, unfortunately, DB plans work. It just takes a little bit of time for them to send us the information.
We list the 3 non-qualified plans. And just to reiterate something I mentioned earlier, the 2 on the bottom, the 401A-17 plan and the excess benefit plan, those are funded as a result of excess funding over the qualified plan limits. So the money that ends up in the bottom 2 on that slide, 401A-17 plan, excess benefit plan, is the result of excess funding over qualified limits. The one listed on top, which we call top hat, is actually the deferred compensation plan. And that's one you need to elect during the fall open enrollment with Southwest Airlines. All 3 of these plans are administered by Southwest Airlines, and you'll find them on the record keeper site at freedomtoretire.com, record kept by Empower.
Some people do ask, why would I want to participate in the non-qual plans? Of course, it's just given the pilot flexibility and having their own choice of having more monies put into some kind of retirement vehicle, especially from shielding it from the federal income tax side of the house. And so if your ultimate plan is to make sure that you can put maybe 25% or 30% of all of your wages in some form or fashion using the top hat or 401A-17 plan or excess plan, these non-qual plans allow you to do that. It helps you with that financial plan, whatever you may have written out for yourself. So as we just briefly described the 3 non-qual plans, 2 of them are for overages or excesses, and one of those is the 401A-17 non-qual plan. That's anytime you have the monies over the $350,000, that wage limit, compensation limit, then it could go into the non-qual plan if you've elected it. So that would be both the market-based cash balance plan, the NEC, and the profit sharing plan. So a point to remember, when you go in and make the election, when you elect for one, you're making it for all of them. So if you say you want 100% of your 401A-17 plan to go into, or the monies to go into the non-qual plan, You said 100% is going to do it for all three plans. Or if you elect 50%, it would be 50% for all three plans. We're talking about the non-qual excess benefit plan. So this is applicable to the SWAPA 401k plan and the Southwest profit sharing plan. If you've exceeded that 415C limit of $70,000 for this year, and you've elected all of your monies to go into the excess benefit non-qual plan, that's where they will go. You can't split them. You can't say you want 50% of the SWAPA 401k excess to go in the plan and 75% of the profit sharing plan, excess of the profit sharing plan to go in. Well, you make that single election and the single point, and they'll all go in there.
And the takeaway on all these non-qual plans, they're not widely utilized. I think the last time I saw numbers on Top Hat, it was like 480 pilots out of our list of 11,000 plus.
So we have a Top Hat non-qualified plan. You have to be invited to participate in this plan, and it's based on the prior year's earnings. So once you hit the certain earnings threshold the prior year, you will get an invite from Southwest that says, hey, you're eligible to participate in the Top Hat plan. This overall has a very low participation rate amongst our pilots. It's not a super popular plan for a variety of reasons. The big thing to know about this is you have a maximum of $50,000 that you can put into this. And beyond that, just like the other two non-qualified plans, the 401A17 and the 415, once you make an election as to how you want that money distributed, that's it. It's irrevocable. And again, the money from this plan is subject to creditors in the event of a Southwest bankruptcy. But it is another way for high earners to potentially put up to $50,000 away from taxes until retirement.
Age has its perks. As mentioned, 2025 402G limits, which are the pilot deferral, payroll deferral, the maximum is at $23,500. However, the year you turn 50, if you turn 50 this year, automatically you qualify for catch-up contributions, also known as IRS 414V. $7,500 additional dollars can be deferred into your 401k from payroll the year you turn 50.
Actually, Drew, it will be deferred if you have enough.
It will
percentage.
be deferred
it's
based on the
optional.
percentage you set. Yeah, exactly.
There you go.
So depending on the amount you have set, if you're going to exceed $23,500, you'll automatically be allowed to defer up to another $7,500 in catch-up. New this year as a result of Secure 2 Act, super catch-ups. Super catch-ups are for those that turn age 60, 61, 62, or 63 in a given year, are allowed even higher catch-up contributions for an additional $3,750 in 2025. So the total possible payroll deferrals from the pilot side is $34,750 for those age 60, 61, 62, or 63 in 2025.
So the crowding out issue, we've alluded to it before, but the crowding out is basically where you don't put in your maximum pilot allowed contribution, $23,500. If you're 50 or over, it diminishes the amount that you can put in from your catch-ups, whether it's a catch-up or super catch-up. If you're under 50, you'd like to get that $23,500 in, let the company put in the $46,500 so you hit your $70,000 limit. If you don't do it, especially if you're a Roth contributor, you're losing some of the tax advantage down the road by not getting your $23,500 in now. So if you're a standard traditional 401k contributor, you're going to pay your tax on it later. Not quite as big of a deal in terms of the crowding out, except that if you're over 50, you lose your ability to put in those catch-up monies. And those catch-up monies, for 10 or 15 years, whatever you've got left in retirement, pretty significant amount of money.
So we always recommend that you at least get enough money in 13%
for 2025 to make sure you hit that $23,500. That way you're going to get all of your eligible catch-up contributions. And especially if you're a Roth contributor, you have the tax benefit come retirement that you can take that money as you wish and not have to pay taxes on it.
Now we're going to go through the examples of the pay statement information. So this is what your layout of your pay statement looks like. You have your earnings, imputed income, employer paid benefits, employee taxes, deductions, and subject or taxable wages. We get a lot of questions from members about where certain things are on the pay statement. So that's what we're intending to do here. So earnings, of course, is going to be your retirement eligible wages. That's your TFPs times your rate. Does include your day per diem. But remember the profit sharing, excess benefit cash, profit sharing over the compensation limit, the excess benefit cash, 401A17 NEC cash, all of that cannot be deferred into the 401k plan. Wanted to call that out. But if they're paid in cash, that's where they'll show. Imputed income, the one thing to remember here is if you do elect the non-qual plans, that it will have imputed income. It just won't have the federal income. The reason they have imputed income, though, is for FICA purposes. So you still have assessment of FICA, just not the federal income tax for those non-quals. This is just indicating the employee paid benefits. That's where the pilot NEC shows up. And remember, that's the qualified funds for the 401k. That's where that line item shows up. If you are curious where the 401k pre-tax or Roth money deferrals show up, it's in the deductions section of the pay statement. This just shows your federal taxable wages and your payroll tax eligible wages. There is no place on the pay statement for retirement eligible wages. Unfortunately, I know that the negotiating committee did ask for that, but that was something they were not able to achieve. Additionally, you don't have anywhere on the pay statement anywhere for the market-based cash balance plan. You actually have to physically go look at the Empower account to see those monies that go in there. There's actually no dollar value for wages that show up on the pay statement.
One of the big questions, especially from new hires, has to do with rollovers. So they're coming from another airline, typically corporate, regional, whatever, and they're asking about either rolling their money into an IRA or rolling it into a 401k. One of the things I always tell folks is if you come into the swap of 401k, you've got $12 billion of funds that are negotiating on your behalf versus going into taking your money from SkyWest, for example, rolling it into an IRA, whether it's at Schwab or T. Rowe or anywhere else. You're going to be in retail pricing. Any of the funds that you can find in retail pricing, I am sure we're going to have funds that are going to be similar enough and that will also have significantly better cost structure. It's now set up so you can just go onto the Schwab site and you can do a transfer.
Yeah, and I'd like to add to that. If you visit swapa.org committee's 401k committee, we've got some help for you there. We have published or republished an IRS rollover chart. You'll find that under the education link, or actually under FAQs. It should be noted that on our 401k committee site, there's a little blue box that might kind of escape you on the lower left. That's the show more box. You need to click that. So if you don't see what you're looking for, sometimes there's a show more box. And you'll find the IRS rollover chart. And as Brian mentioned, there'll be some guidance there. Are you able to roll over an IRA into the 401k? Yes for traditional, no for Roth, for example, and on down the line, 403B plans, whatever other qualified retirement plan you may have. There's an IRS chart you can follow and it's simple to read. And then we've provided a link to roll over a qualified plan or IRA into the 401k. That's what the tab's called. Roll over a qualified plan or an IRA into the 401k plan. And that has instructions and links. So from those two tabs found under our committee homepage, you can work your way through that FAQ Brian just mentioned. Rollovers. Damian, you got any FAQs that you would like to mention?
I can't remember if you covered it or not, but the side letter 2 that just did pass by the SWAPA Board of Directors, it did include starting January 1st of 2026, the ability to defer up to 80% from the current 50%.
Another question we get fairly often, and we've written RP articles on this. We've negotiated with our record keeper, Charles Schwab, for what they call the concierge service. It's a free retirement planning service, just kind of a basic overview of your entire finances, not only your 401k, but a spouse's retirement plans, IRAs, home mortgage. The more you give them, the more you get out of it. You can arrange that concierge service meeting with Schwab. And again, it's free. Pilots like free. That service probably is in the ballpark of $1,500 if you went out and bought it. There's a link, again, at swapa.org under 401k committee, under committees 401k, under FAQs, you'll find that. And you may have to click the blue show more box to find that FAQ. And there's a link where you can schedule that appointment with Schwab. It's no obligation, no costs. It's just sort of a retirement planning feature.
So I don't want to go into a whole lot of detail because it's a little off topic for this particular podcast, but a lot of questions do come in about where else if I want to. I'm not interested in a non-qualified plan, but I'm looking at other ways of where else can I put money. And I'll say there's two things that I always say right off the top. If you have the ability to fund an HSA plan, it's got triple tax savings. We won't go into all details on that. I've written some articles on it. You can find those under our committee site as well. But the HSA plan, if you're in that plan, you can
put away another $8,500 for a family.
The other thing is, and I've talked to several pilots about backdoor Roth. If you don't know what that is, Google it, look it up, whatever you need to do. But if you have accounts at Schwab, T. Rowe, wherever, talk to them about possibly doing a backdoor Roth. So even though you may not meet Roth qualifications, you'll meet qualifications for a backdoor Roth because
You're simply making a non-deductible IRA.
and then flipping a switch immediately to pay your taxes on the no earnings that you have if you've done it that day and turning that into a Roth account. So just a couple of ways of deferring more money that's outside of sort of the scope of this podcast for sure. But it's a very common question for, our high earners that are trying to defer more funds. There are insurance policies as well, but again, it takes us out of a fairly long rabbit hole at this point.
Mentioned earlier is federal law referred as Secure Act 2.0. And one of the provisions of Secure Act 2.0 was mandatory Roth catch-up contributions. So we mentioned catch-up, both catch-up 50 plus and super catch-up for those turning age 60 to 63. Catch-up contributions in 2026 will be post-tax or Roth contributions only for those that have earned over $145,000 in 2025. It's a side letter to payroll deferral. As of 2025, a pilot can elect to defer 0 to 50% of their earnings into their 401k. Starting in 2026, that number moves to up to 80%. Now, there are some folks that are interested in deferring more than 50%, all the way to 80%. I could give you a hint on a couple of the groups that it would contain. First, we'll call front loaders, people who really want to get their money in quickly, and cash flow isn't an issue. And non-tax loss of license recipients. They would like to defer, often they would like to defer a larger amount to their 401k. Because they're only getting that deferral from vacation earnings and sick. So one more note on that side letter to payroll deferral. And Matt did want us to mention this. The election for January 5th, which is the first payroll of 2026, that election change has to be made between December 10th and December of 24 of this year of 2025 to take effect for that higher payroll deferral next year. We've talked a lot about limits here, primarily about 2025, because that's what's known. The 2026 limits will be announced around early November. They'll be updated a couple places. Our retirement calculator will be updated on swapa.org, committee's 401k committee. And there's a neat sheet of all kinds of useful information. It's called the 2025, which will be 2026, limits for benefit plans and other useful info. That, the co-author of that sheet is on this podcast, Damian. Do you have anything to add to that? It's one place we update these annual limits.
Yep. As soon as all the numbers and Social Security and everything else is updated, we update it that day and post it up. So
the 401k committee and SWAPA retirement plan administration, we're coming up with some checklists. These are retirement checklists. We have 3 of them. We're working with our record keeper, Charles Schwab, to publish them. They should be available to view this fall. So this is just sort of a tease. Retirement checklist. There are numerous things to think about as you approach retirement. And so we're going to have a checklist that's targeted for those 5 years from retirement, and one from 5 to 3 years prior to retirement, and yet another checklist of the 1 to go, 1 year prior to retirement. You look for those at our committee website on swapa.org. And Brian, you've been kind of a big advocate of these checklists. Feel free to add anything there on that one.
Yeah, I would just say that, there's thousands of resources all over the internet, but a lot of those resources are really not geared towards the high income earners. You have your ultra high net worth folks, the CEOs of Fortune 500 companies that will have, professional managers and private wealth services and all this sort of stuff. But for those of us that are sort of in that realm where we're not quite into this super high net worth, but we make a good living and we have, a good amount in retirement put aside, I think it is really important to start thinking about these retirement things. And so one of the things that I always, like to say is, look, if you're a few years from retirement and you know that your house you're keeping your house for retirement, you need a new roof, go ahead and get that new roof while you're in your working year so you can pick up your VDT, your premium, or whatever you need to pay for that. But you don't want to come into retirement with debt. You don't want to come into retirement without a nice cash cushion. If you've read anything that I've read, I read a lot of stuff on sequence risk. So I just think it's important if you go through these checklists, depending on where you are in that point in time. And quite frankly, even if you're 15 or 20 years from retirement, I think it's worth reading these checklists to keep in the back of your mind. We do have a lot of folks that are upgrading at later points in life. And, one of the things you don't want to do is be the 52 or 53-year-old captain with 12 years left, but you want to buy your captain's house now on a 30-year mortgage. When you get into retirement, you've got 20 years of mortgage payments in your retirement. That will definitely eat into that income stream. So I think these checklists are going to be really good. I think it's going to go a long way towards helping with that thought process and planning for those of us that are we're pretty comfortable. We make good money, but we're not the Jeff Bezos of the world where you can go and rent an entire place in Italy. And, so I think it'll be worth everybody's time to look through those, no matter what age you are and how close you are to retirement, and then just keep them in your back pocket as you start hitting those metrics.
And I would add, there's going to be some specific things to SWAPA pilot that would apply to SWAPA pilots, like turning off your loss of license. That's something you don't need when you're 1 month prior to retirement.
Yeah, or maybe even 1 year prior to retirement. There's definitely things you need to look at and think about as you start getting towards those retirement years. We can't really give advice as a 401k committee, but, there's a lot of information that's out there if you read through some of our old articles, which they're all online. But I know that Drew and I have talked about, Roth versus traditional and what the advantages of some of those, especially as you approach retirement. We've talked about required minimum distribution, what you're required to take out. The tax man's got to get you at some point. And that's what that required minimum distribution is going to be. And they keep pushing that off, which is fine. But it's definitely worth looking at some of those articles where we talk about having cash cushions, making sure that you've got cash to sort of buffer down markets so that you're not taking retirement money out. And that's what I mean by sequence risk is, when you're taking your money out in a market that's declining, a 50% drop in the market requires 100% increase in the market just to get back to where you were. So it's just important to have some of those concepts and have some of those understandings and really think about, especially as you get into those last couple of years, what the plan is. If you decide that you need more income because you've got multiple kids that are still in college because you started a little later in life, things you need to think about in terms of, if you're still working, what those requirement or what you're going to end up taking out of your 401k versus what you're going to be making in a retirement job. So just all components you need to keep in mind.
Okay, so starting August 1st through August 22nd, we have our plan-to-plan transfer window will be open. The plan-to-plan transfer, the plans we're referring to here is profit-sharing transfer, which is administered by Southwest Airlines and record kept on the Empower website. That the money that a pilot has in there can be transferred to the SWAPA 401k. This year, there's 2,589 pilots eligible for the plan-to-plan transfer. Some of the qualifications are you didn't transfer last year because it's a one-time, once-in-a-lifetime event. The window is open every year, but it's only one per pilot, one-time transfer. You're under age 59 and a half. You're fully vested, which means 5 years in your profit-sharing plan. And in order to take advantage of the plan-to-plan transfer, you would visit workplace@schwab.com, the homepage, and then there's a My Notifications, make your profit-sharing transfer election, enter the percentage you select, and it can be all the way up to 100%. And one additional note, if you are intending to participate in the plan-to-plan transfer, if you have an SDBA, self-directed brokerage account, within your profit-sharing plan, the assets in that brokerage account or brokerage window need to be sold and settled prior to transfer. And that money needs to be transferred to a core fund within the profit-sharing plan. So if you're an investor with a brokerage window and you have specialized investments in your brokerage window, they need to be sold and transferred to a core fund and settled. Give it 3 or 4 days, I would say, prior to transferring that money to the SWAPA 401k plan if you intend to transfer that money. And again, the window is open from August 1st to August 22nd.
Thanks to Andrew, Brian, and Damian for crunching the numbers and educating us on one of the most important parts of your career at SWAPA. And while this covered a lot of ground, there is a myriad of resources on the 401k website. If you had some questions following this presentation, there's a pretty good chance the answer lives on their page. There are retirement calculators that get periodic updates, an animated version of the pipes diagram you just saw, and multiple blogs about topics from these same subject matter experts. We work our whole career to retire the way we want to. So put this page in your cross-check and get familiar with all it has to offer. That way, after your Finney flight, you can transition smoothly into your next chapter with confidence, knowing you made informed decisions along the way. Thanks for watching, and as always, fly safe, fly informed.